Investing is one of the most effective ways to build wealth, and it all starts with a strategy. But which strategy is right for you? Over the next couple videos, we're going to be really diving into some investment strategies, figuring out which one is going to make most sense depending on your flexibility, exactly your risk tolerance, what you're looking to get out of this, what time period you have to. So let's go ahead and get into it. First one we look at is investing dividends. So dividend investing is one of the absolute most popular things that we see right now in the investing world. Dividend investment strategy involves investing in stocks that regularly pay dividends or ETFs that pay dividends out to the shareholders. Now, dividends are a portion of the company's earnings that are distributed to its shareholders as part of owning stock in a specific company. Now, not all companies do pay dividends. Now, there are some that pay a lot of dividends. Now, you have to remember, guys, when it comes to a company that is paying dividends, they have the option of either returning dividends to their shareholders or holding on to that money and actually putting it back into the company, which is what a lot of companies do. When you look at some of the larger ones like Berkshire Hathaway and Warren Buffett, they do not pay a dividend. However, they do focus on growth, which we'll get in just a little bit. So companies that pay dividends are usually well established. When you look at Coca-Cola, when you look at Verizon, when you look at a lot of the well-established larger companies within the United States do pay a regular dividend, whether it is monthly, whether it is annually, whether it is quarterly. Dividend paying stock has historically less volatile than non-dividend stocks. Now, as a stock kind of progresses and it can go up and down, dividend yield can make up even some of those downturns with the dividend that you're actually getting, making them a very popular choice among investors who prioritize not only stability, but also the income generation. Now, investors can choose to reinvest the dividends, which I absolutely recommend, guys. Now, with the reinvestment of dividends or the dividend reinvestment plan or DRIP, you are actually taking the dividends and purchasing more stock in the company that is yielding you dividends. This can be kind of the dividend snowball, and also it helps compound the returns over time, potentially increasing the total return on the investment that you are really holding on to. Now, this comes with several advantages. Now, number one, guys, the stable income. Dividend investing can provide a stable stream of income for investors, has a lower volatility. So dividend paying stocks have been historically less volatile than non-dividend paying stocks, which can help reduce the risk of a portfolio or even balance it out depending on what you're holding. Now, the big thing with dividends, guys, is the long-term mindset. Companies that pay consistent dividends are often well established, have a track record of long-term growth potential. Now, with this, it doesn't mean that it is going to be a year, two, even three. When we look at like SCHD, when you look at even the high dividend yields from Vanguard, you're talking at a 10, 20, 30 year term, holding out some of these. That way you can compound those dividends over an extended amount of time. So with the dividend investing, there is also some disadvantages, guys. And number one being the limited growth potential. Now, companies that pay dividends could have chosen to invest those dividends back into the business, which could limit the growth potential to non-paying dividend companies. Like I said before, either they're paying out the money as dividends to shareholders, or they're going to go ahead and take that money and reinvest it into the company, which could include research and development, marketing, promotions, things of that nature. Now, disadvantage number two is dependency on the company's performance. When it comes to a company, if a company is in dire straits, if a company is not performing too well, dividend payments are usually the very first thing that we see are cut is the dividend payments. They are not guaranteed, and the dependency of the company's financial performance. If a company has a downturn like we've seen in the market with the rising rates, there are a lot of companies across the board that have cut or suspended dividends that they were paying. We've even seen some dividends that were paid on a monthly basis that moved it to a quarterly basis. That way the cash flow is a little bit different. Now, the final one for this, guys, is the tax implications. Dividends may be subject to tax depending on what you're doing with them, which could reduce the overall return on investment, which again, when you look at a portfolio, a lot of times you're not going to see that until you're subject to the tax, so you go to file your taxes. So if you're saying, a high dividend yield is paying you X amount, you see a pretty solid return, then you have to pay all the taxes. You have to keep that into account when you are covering those costs. The second one we talk about, and my favorite, guys, is dollar cost averaging. So with the S&P 500, I have dollar cost average over the last 12 months. We've yielded about a 30 to 35% return through dollar cost average. So what exactly is this, guys? Dollar cost average is a strategy that involves spreading out your stock purchases over time, regardless of the market going down, regardless of the market going up, the price, the volatility, anything of that nature is kind of nullified with dollar cost averaging. So what I did was every 2 weeks, I put $500 into the S&P 500. Last year, the performance was about -22. I bought it when it was lower. I even bought it when it was at the rock bottom because, again, every 2 weeks making purchases. This is an ideal strategy that allows you to buy more shares when the stock drops, fewer shares when the stock rise, but over time, this strategy will lower your cost average, which is exactly the dollar cost average reason, building your position in the investment you believe in, leveraging the power of compounding growth with your money. Now, again, everyone has its advantages and disadvantages, guys. Dollar cost averaging advantages reduces the impact of market volatility. This is one big thing, is not only when it comes to stocks and bonds, ETFs, things of that nature, but even if you're looking to be an investor into cryptocurrency, I really advise and highly advise dollar cost averaging. Now, again, looking at the advantages, reducing the cost of the volatility by investing in a fixed amount of money at regular intervals. Dollar cost averaging can help you smooth the impact of the market volatility in the portfolio. Disciplined approach to investing. Dollar cost averaging has to be very disciplined, guys. This is why I set it up automatically, so it can just go ahead and do regular intervals with the investing. I don't pay attention to the stock market, how it's performing, or where what I'm investing in is already kind of set in my portfolio. And the final advantage, guys, is a potential for higher returns. Over the long term, dollar cost averaging can potentially generate much higher returns than the market, which is exactly what I'm seeing, because 2022 again was a very heavy down market. Now, some of the disadvantages to dollar cost averaging is you could miss opportunities, guys. If by chance you go to put money in the stock market, and let's say instead of putting $10,000 in, you put $1,000 a month for 10 months, overall, if the stock continues to increase for that entire 10 months, if you put the $10,000 up front, you essentially would have a much higher investment than waiting month by month to month to go ahead and invest in there. Now, the other disadvantage is no guaranteed of profit. This is the big reason, guys, when it comes to investment strategies, dollar cost averaging does not guarantee a profit and could even result in a loss long term because of the volatility that we see within the stock market. So, guys, I hope it really broke down two investment strategies. They are actually two of my absolute favorite. When you look at dividend investing, I invest in dividends, again, through the S&P 500, the VOO, the SCHD, couple dividend ETFs. Now, I do not stock invest in dividend investing, so I do not put it into specific stocks that yield dividends. I know some people that do build portfolios such as that nature, but I do stick to the ETFs. That way we have a lot more spread risk across markets and across a lot of different things that are paying dividends that yield a pretty good return. And then, of course, the second one, guys, the dollar cost averaging, one of my absolute favorite things. This is something I've actually been doing for years through stocks and also through cryptocurrency. Dollar cost averaging has made a huge difference with the volatility that we have seen in the market, and potentially, and it has yielded me personally a significant higher return than we have seen in the past because of the dollar cost averaging. So, all right, guys, so that'll do it for today's video. Let me know below what you guys think of both of those methods. Again, we're going to be covering a couple different methods and investment strategies over the next few videos, so you can really get a taste and see what is going to work for you. Or let me know in the comments also what investment strategies that you have been utilizing. And as always, thank you guys for watching.